I'm actually in the process right now of putting together some slides for a presentation I have to do for Belpointe advisors around the country tomorrow. And this is a chance for me to express myself and just kind of get my thoughts out in the open, kind of air them, and maybe test out a few things at the same time. So let me kick it off. So a couple of things I'm looking at, and I've got some charts up here. I'm not sure I'll share them or not. But in any event, the first thing I'm looking at is an S&P 500 in white. That's the price chart. And then the earnings yield of the S&P 500 superimposed over that, that's in blue. And then at the bottom chart, end of the chart, what we're looking at is 10-year yields. And this is going back about, say, 4 years, just right after COVID in here. And so one of the things you look at here is that I look at the earnings yield of the S&P 500. That's a trailing basis, all right? It's a little over 4%. So maybe it'd be a little better, if I was looking forward on a forward basis, maybe it'd be closer to 5%. But you got about, a 4.5% 10-year yield. And it begs the question, they're so close to each other. Are we being paid to really take the risk? I'm not sure that we are. I look at this and it's interesting. It makes one think. We've come a long way. And are we being paid enough to take the risk? There's a lot of moving parts in this. And I've always thought that where 10-year yields sit, it's a big driver of the market. We know that we're higher for longer. We know that the Fed is going to remain where they are for longer than we thought. We've been wrong on that for more than a year. The inflation data just has not been supportive enough. Maybe the first cracks that we're getting in terms of the economy is we saw, some of the jobs numbers on last Friday a little weaker than expected. And of course, stocks, what do? They rally because suddenly bad news was good news again. Maybe the Fed won't have to do something, more draconian. But each stair step higher in rates, there's a price for that because it pulls institutional capital out of the market. Institutions can now match a future liability with something other than a stock. If you're an insurance company and you're writing an insurance policy, why not lock in the return you need with, say, a AA corporate bond that's trading above the yield of a treasury that might be enough for you? Why take the risk of stocks if you don't have to? That's part of the challenge that we're doing here, that we're dealing with. Other things that are a bit bothersome, we had a sell-off that was right at the end of the first quarter, which was a great quarter. We rocked in the first quarter. March was horrible. March was great. That was the end of the first quarter. April was terrible, horrible quarter. Stocks sold off hard. Rates were rising. People were pulling out of risk assets. And so far in May, we've had, something of a bounce, a reversion to the mean. Maybe that was the bottom and we needed this little pullback in the market. But some things that are happening that are just a bit odd. And one of them is utilities. If I look at utilities right now, and this is the year-to-date performance of sector performance, all right? And you'll see there that utilities are rapidly moving up, all right? Rapidly moving up. Worst performer is real estate down in the toilet, but it's almost approaching energy and communications, which, by the way, is just really two stocks. It's Alphabet and Meta. So it made me question, okay, utilities are fairly defensive. Why is that kind of happening? So I went back and I decided to look at some previous bear markets. I went all the way back to the dot-com bust, which was my first bear market. And I went back and looked at the dot-com bust. And the chart I'm going to show you is from the beginning of 2000. Let's call it May of 2002. And there was a recession in between there. Utilities weren't the best performer, but they were certainly 1,300 basis points better than SPDR, the S&P 500, and a whole lot better than technology, which was down 64% in that time frame. All right, so that's one bear market. So utilities did their job; they were a defensive asset class. Great financial crisis, the mother of all bear markets, You're looking at 2008 to March 2009. And look, utilities didn't do great. I mean, they were down pretty substantially. This is not counting the dividends, but needless to say, it was a bad period of time for utilities. It was a bad period of time for all stocks. But if you throw in the dividend, a lot better than the S&P 500 and way better than financials, which were down 78%. So again, it did its job. It was a defensive asset class. Let's move forward a little bit. I like this one. This one, I call it the bear cub. Very short. We're only looking at the fourth quarter of 2018. And utilities actually were up a little bit during that period of time. You throw in the dividend, it was probably up a few percent. Energy was the worst performer, down about 24%. But every other sector was down during that time frame. Certainly wasn't a good time for technology. I got hammered back then. What was happening back then? 10-year yields were actually just crossing above 3%, and institutions were getting the message, oh, wow, maybe we can do something with the 10-year yield. So 3% was enough to do that. Hell, if you approach 5%, that's got to be a line in the sand for stocks. That would hurt. And I think the lesson learned from me, having done this for a while, is that I think markets maybe we can stand higher rates. What we can't deal with is rising rates, because when they're rising, we have no idea where it's going to stop. And each stair-step higher becomes very fearful, and we start pulling capital out of the markets. Let's look at another one. Let's look at 2022. That was a pretty significant bear market. So the chart you're looking at of sector performance goes from the beginning of 2022 to, let's call it, I think the bottom was sometime around the end of September. Energy was the clear outperformer, actually very strong year for energy that year. Utilities, the next best performer, and well above the S&P 500 and well above communications, which was basically Alphabet and Meta, which was bringing up the rear back then. And that was, of course, the bottom of the bear market. And markets have been pretty resilient since then. But let's look at where we are right now. Let's just pull it forward. The current quarter, utilities are screaming, right? Up just on a price basis over 7%, throwing a dividend probably closer to 8, maybe 8.5, and well above real estate, which is bringing up the rear. And real estate is important because one of the things that where is it here? Barry Sternlicht. I caught this just on CNBC this morning. Barry Sternlicht, Starwood CEO, well-known CEO. He should know something about real estate. He's looking for one regional bank failure a week if we continue with this higher for longer matrix, maybe even 2 a week. And it wasn't that long ago. It was about a year ago we saw the collapse of Silicon Valley Bank and Signature Banks because where Fed funds was trading and the fact that their bond portfolios, their held-to-maturity portfolios were deep underwater. That was a problem for them. We stay higher for longer, there's probably an accident down the road. Yet, through all this, markets have been resilient. So it takes me back to the utility trade. Is it really a warning sign? And it could be either, because in some ways this utility trade is unique in that it is a defensive move for sure, all right? But it could also be an offensive move, because one of the biggest themes in the market right now, and perhaps the biggest theme in my career as a portfolio manager, is artificial intelligence. And one of the things we're learning is beyond technology, beyond all the companies that are going to use this technology, we're going to need energy and a lot of it. And that means the only one thing, we're going to have to build up the electric grid, and we're going to have to pump a lot more electricity. And it's going to come from a lot of forms. It could come from your nuclear, it could come from fossil fuels, solar energy, alternative energy. But in the end, these utilities will be pumping more electricity. That's got to be more revenue. And if they run their business right, a lot more money to the bottom line. So that's just me thinking out loud. I hope you enjoyed this. I'm David Nelson. And of course, this is The Money Runner.